Hey everyone, before we dive in, here's something really cool. You're listening to an episode created almost entirely by AI. From the script to the voice, this is part of the AI Takeover series by Blockchain DXB, where we explore what's possible when humans hand over the mic to machines. There's little to no human involvement, and that's what makes this episode so powerful. Welcome to the future of content creation. Let's get into it. This episode is powered by Amana, the region's first and fastest growing regulated all-in-one trading and investing app. Whether you're looking to invest in US stocks like Apple or Tesla, or MENA giants like Adinoc or Salik, Amana puts the financial market at your fingertips. You also get access to gold, foreign exchange, ETFs, futures, and commodities. With over 375 assets to choose from, they've got the largest crypto selection in the region. And listen, guys, if you want to build long-term wealth without thinking about it every day and want to automate your investing, just set your monthly budget, choose your preferred categories, and let Amana do the rest. No fees, no lockups, and 100% customizable. Even better, funding your account is frictionless, and funding your account is easier than ever. You can fund your account with Apple Pay, Google Pay, credit cards, instant bank deposits, and even your crypto wallet. No friction, no hassle. And if you get stuck, Amana offers 24/6 real human customer support and personalized sales assistance. Because you're part of the Blockchain DXB community, you get an exclusive offer. Register with the code BlockchainDXB and make at least one trade to receive a $100 trading bonus credited to your account the following month. So what are you waiting for? Download the Amana app now. The link and code are in the show notes. Next up, Blockchain DXB is proud to be the official media partner for one of the biggest blockchain events of the year, the Blockchain Futurist Conference. For the first time ever, North America's leading crypto event is heading to the United States, taking place at the iconic Guitar Hotel at Hard Rock in Hollywood, Florida. Alongside it is ETH Women, happening simultaneously. Expect multi-stage panels, NFT galleries, DeFi showcases, tech demos, metaverse experiences, and more, all under one roof. It's where the smartest minds in blockchain, crypto, and AI will converge. Get 25% off tickets by using the code DXB25. And yes, I'll be there with exclusive live coverage, behind-the-scenes interviews, and spotlight features on groundbreaking projects. Mark your calendars, November 5th and 6th, 2025. Visit futuristconference.com and use code DXB25. Link is in the show notes. Next up, Blockchain DXB has two more interesting partnership news to announce. First up, with Future Blockchain Summit and Fintech Surge 2025. Blockchain DXB is an official media partner of Future Blockchain Summit and Fintech Surge 2025. Future Blockchain Summit is one of the biggest and oldest blockchain summit taking place in Dubai, going back to almost a decade, 2017 to be precise. The event takes place between October 12th to 15th at Dubai Harbour. This is where blockchain meets fintech to redefine the future of finance. 250 plus world-class speakers, 1,200 plus investors, live demos, product launches, and the exclusive invite-only GITEX Digital Assets Forum, all under one roof. From Web3 pioneers to fintech leaders shaping payments, banking, insurtech, AI, and DeFi, this event brings the entire ecosystem together. Startups, this is your launchpad. Get in front of top VCs, accelerators, and industry leaders. For blockchain and fintech companies, this is where connections turn into partnerships and dreams turn into exits. Register today at futureblockchainsummit.com. Don't just watch the future unfold, own your space in it. Remember, Future Blockchain Summit and Fintech Surge 2025. The registration link is in the show notes below, and see you at Dubai Harbour. Second partnership news kicking off from today is with the leading Bitcoin event organizers on this planet. And this year, Bitcoin Asia is taking things to another level. Bitcoin Asia are hosting a massive gathering this August in Hong Kong, and Blockchain DXB is proud to be an official media partner of Bitcoin Asia 2025. Taking place this August in Hong Kong, Bitcoin Asia is the region's premier Bitcoin gathering, where builders, investors, and innovators meet. It's really an honor for Blockchain DXB to be associated with Bitcoin Asia. Now at this event, expect powerful keynotes, bold conversations, and a headlining session with none other than Eric Trump. He will be sharing his vision for Bitcoin's long-term potential, its role in global finance, and Asia's massive impact on adoption, and a lot more. So listen up, guys. From infrastructure to regulation, privacy tools to lightning development, Bitcoin Asia connects global Bitcoin communities and drives innovation across cultures and markets. And as part of this partnership, you can register for the Bitcoin Asia using the code DXB. All the details are in the show notes below. If Bitcoin's in your blood, this is your event. So, register today at asia.btc and don't forget to use code DXB for 10% off your tickets. Bitcoin Asia 2025, Hong Kong is calling. Be part of the future of Bitcoin. Next up, Advanced Media is the largest distributor of professional video, photography, cinema, and broadcast accessories in the Middle East. They represent over 100 major brands, including DJI, Hasselblad, Red, and Rode. The mic I'm using to record this? Sponsored by Advanced Media. But what really sets them apart is their commitment to purpose. People, planet, and prosperity. That's not just branding, it's their actual business model. They've partnered with SAE Institute in Dubai to offer scholarships to students pursuing a bachelor's degree in filmmaking, each worth AED 50,000. They also run regular workshops, training programs, and tech showcases across the region. For more info, visit amt.t, that's amt.tv. Finally, let's talk about something every crypto investor should take seriously: security. And that's where Ledger comes in. Ledger is one of the most trusted names in crypto security. Their hardware wallets, like the Nano S Plus and Nano X, keep your assets safe by storing your private keys offline. That means you're protected against hacks, malware, and phishing attempts that can compromise online wallets. The company is headquartered in Paris and is constantly innovating. Their team works with world-class security researchers and regularly tests their own products for vulnerabilities. It's why Ledger wallets are used by millions around the world. Using a hardware wallet isn't just smart, it's essential. If you're serious about crypto, it's time to stop relying on centralized exchanges or browser wallets. Click the link in the show notes to order your Ledger wallet and support this podcast at the same time.
Welcome to the Deep Dive. So if you're anything like us, you've probably been watching the price charts and, well, the start of December looked a little rocky, frankly.
It did. But what's really interesting is when you zoom out, you shift from that day-to-day volatility and look at where the trillion-dollar smart money is actually going.
And who's building the infrastructure?
Yeah.
When you look at it that way, the landscape is, well, it's shaping up to be phenomenal.
That distinction is just crucial. Volatility obscures commitment. So our mission today is to really chart this complex late 2025 landscape. We've pulled sources that reveal some massive institutional reversals, the emerging power of tokenization.
And also how regulatory friction is just crushing certain parts of the market.
Exactly. Specifically that whole privacy coin narrative. It's a fascinating contrast.
Absolutely. We're cutting through the noise to get to the signal. And just as we jump in, you should know the general market sentiment has shifted. We've moved from extreme fear to just fear.
Right, settling at a value of 22 on the index we track.
So an improvement, sure, but it really underscores that cautious mood that's still out there, even with all this massive institutional groundwork being laid.
Okay, so let's unpack this.
Let's ground ourselves in the economic calendar first. December is, it's historically a pretty positive month for digital assets anyway.
That's the Christmas bonus effect, right? Employee bonuses, financial rewards, that provides extra income that often flows into investments.
Exactly. But this year we have two very specific dates that are driving the narrative.
Right. So first up is December 10th.
The Fed meeting.
That's the one. That's when we hear from Federal Chair Powell on interest rates. And, all the research we're seeing suggests there's a really high chance he'll announce a rate reduction.
And historically, rate cuts are a huge optimistic signal for risk assets.
A major signal. It lowers the cost of borrowing, encourages liquidity. A good sign across the board, including digital currencies.
Okay. And the second date?
December 18th. That's when the CPI data, the Consumer Price Index, is released.
So the classic inflation measure.
Exactly. And that data will give us the clearest picture of whether the Fed's policies are actually working. It gives us a very fair assessment of where prices might be heading next.
So if we look at the money movements right now leading up to these dates, the picture looks a little confusing on the surface.
It really does, which is why we need to dig in. The overall ETF market saw some moderate outflows, about $45.4 million.
And the big headline, the one that caused some short-term panic, was Bitcoin.
Yeah.
It saw $151 million in ETF outflows.
And if you stopped there, you'd think institutional money was pulling out.
Right. You'd assume the worst.
Precisely.
Yeah.
But if you connect the dots, you see a completely different story. While Bitcoin ETFs were seeing that selling pressure, three key altcoins.
Ethereum, Solana, and XRP.
Exactly. They saw significant coordinated inflows. Ethereum ETFs brought in $96.6 million, Solana saw $53.1 million, and XRP was up $35 million.
That's not a panic move. That sounds a lot more like institutional rotation.
It looks exactly like diversification. Moving out of one asset and into others, maybe to chase a new narrative or what they see as a better value play.
But the thing that really gives us the clearest indicator of long-term confidence, it wasn't the ETF flow at all.
No, not at all. It was the movement in digital asset treasury inflows.
And this number tells the real story.
It really does, because treasury inflows, that's a measure of big entities, corporations, financial firms buying crypto assets and adding them directly to their corporate balance sheets.
This is the definition of a long-term, non-speculative move.
It is, and that number, it just surged to $2.4 billion.
$2.4 billion. And what was it just last month?
In the final week of November, it was below $1 billion.
Wow.
So when you see companies more than double their long-term digital treasury holdings in a week, it signals they're looking at these assets as a permanent store of value, not just some product to trade. It suggests these assets belong right alongside cash reserves or gold.
And that quiet confidence is now becoming, well, very loud public validation. The first big one we have to talk about is Bank of America.
Oh, this is huge.
They officially recommended clients allocate up to 4% of their portfolio in Bitcoin.
4%. I mean, for anyone in traditional conservative wealth management, a 4% allocation is a watershed moment. It's a huge amount.
It means they don't see Bitcoin as some exotic speculative bet anymore.
Not at all. They're giving it a structural, long-term role in a risk-managed portfolio. It legitimizes the asset in a way that, frankly, years of crypto-native hype never could.
But the real earthquake, the one that signals a massive systemic shift, that involves Vanguard.
Vanguard, one of the biggest, most respected financial companies on the planet.
Yeah.
Trillions under management. And until very recently, famously
I
anti-crypto.
remember that well. They wouldn't even let their clients trade the spot Bitcoin ETFs when they launched.
Their reasoning was always that it was too risky, too speculative for the average long-term investor.
So what changed?
The regulated structure changed. Vanguard has now decided to allow regulated crypto-linked investment funds, so ETFs and mutual funds, to be traded on its brokerage platform.
A massive reversal.
It's a total reversal, driven by continuous, undeniable demand. And, critically, the recognition that these new regulated funds are, and I'm quoting here, more matured and proved reliable.
And that one move just opens the door to Vanguard's, what, 8 million self-directed brokerage customers?
8 million! That is a giant new pool of capital that can now frictionlessly access the regulated digital asset economy.
But there's a catch, right? A detail that highlights their philosophy.
A very critical detail. While they are opening the platform, they've explicitly said they will not be creating their own crypto products, and they'll exclude funds tied to highly speculative assets.
Like meme coins.
Meme coins are the prime example they gave. So they're participating, yes, but only within the absolute strictest boundaries of regulation and maturity.
Okay, so Bank of America is telling clients to buy 4% Bitcoin. Vanguard is letting millions of clients buy the regulated products. What's the immediate ripple effect on the rest of Wall Street?
No, it creates undeniable competitive pressure. The major rivals, JP Morgan, Goldman Sachs, Morgan Stanley, they are now on the clock.
Banks hate losing assets under management.
They hate it. And if their clients see that their peers are getting 4% allocation guidance from BOE and seamless access from Vanguard, those competing banks will be forced to revise their own guidance. They have to match this new benchmark or risk looking slow and losing out on a whole new asset class.
So let's talk about the tech that's needed for this institutional acceptance. The infrastructure for this new era is being built right now, and the first big narrative is asset tokenization.
And our sources suggest this is accelerating really rapidly heading into 2026.
The latest signal came from Kraken, right?
That's right. Kraken, one of the original exchanges, just bought Backed Financial, which is a platform that specializes in tokenization. And this isn't just a merger, it's a strategic move. Kraken wants to become a dominant institutional-grade platform for way more than just cryptocurrencies.
The idea is efficiency. You want 2047 issuance, trading, and settlement of tokenized security stocks, bonds, all on the blockchain. We know BlackRock CEO Larry Fink is a huge proponent of this.
He's on record saying tokenization could transform finance. It connects traditional finance's assets with blockchain's efficiency, but there's a critical technical constraint noted in our source material.
Which is?
The opinion that tokenization may only work reliably in permissioned blockchains, not open ones.
Explain why that distinction is so crucial.
Well, think of it this way. Open blockchains, like public Ethereum, are decentralized. Anyone could access them. Permissioned blockchains are more like a private, club-only vetted KYC-compliant members can see or move assets.
And for highly regulated real-world assets like real estate or stocks, you have to maintain strict control.
You absolutely must. You have to know who owns them and where they're traded for compliance. You can't have those assets accidentally moving to a sanctioned individual, for example. That regulatory need for control just naturally pushes tokenization towards those permissioned environments.
Okay, moving to stablecoins. We're seeing a lot of expansion here too, driven in part by the clarity from the Genius Act in the U.S.
Right, that act essentially clarifies the regulatory standing of stablecoins, making their issuance and reserve requirements much clearer for banks.
And that clarity allows companies like Sony Bank to jump in.
Exactly. Sony Bank is partnering with Bastion to launch a secure U.S. dollar-backed stablecoin. And this is a Tokyo-based bank taking its digital asset strategy global.
And given Sony's huge presence in gaming, the potential for using stablecoins for in-game purchases or digital asset transfers seems massive. It could redefine that industry.
It absolutely could. And what's really fascinating is that the global trend goes beyond just the US dollar. We're seeing banks in various countries, emboldened by their own local regulations, launching stablecoins backed by their own national currency.
So the euro, the yen, and others.
Right, which suggests that regulated digital currency is becoming core national financial infrastructure, not just some auxiliary product.
Now let's talk about a narrative that seems to be collapsing under that same regulatory pressure. Privacy coins.
Right. After that high-profile Bitcoin confiscation by the FBI in the UK back in October, there was a sudden panic.
Certain crypto enthusiasts got worried their assets could be easily tracked.
And that anxiety fueled what we call hyper-speculation. We saw a huge pump in assets like Zcash. It briefly hit highs around $700 while Bitcoin was taking a hit.
But that growth wasn't real, was it?
Not at all. Our sources were clear. It was driven entirely by fear and speculation, not real fundamentals.
And that speculation just evaporated. The price of Zcash collapsed by over 50% in days. The market cap took a massive hit, dropping from over $7.5 billion down to $5.05 billion. It lost its top spot.
And the king remains Monero, or XMR.
It's just held on.
It's held strong. It recently crossed the $400 mark, and it's retaining that top spot with a market cap of around $7.29 billion. Its resilience really highlights a difference in structure. It's often seen as having stronger decentralization and a higher degree of exchange resistance.
But the whole Zcash collapse really highlights the core existential problem for this entire sector, which is government and centralized exchange control.
That's the crux of it. Privacy coins promise untraceable transactions, but the vast majority of users need centralized exchanges to get them, and governments can and do pressure those exchanges to delist them.
This isn't theoretical. We've seen it happen before.
And we're seeing it happen right now. A perfect example is Dubai's Virtual Asset Regulatory Authority, or VARA. They've issued what is basically a big fat red no to privacy coins. They've even prohibited related meetup events.
When a major global financial hub explicitly prohibits the trading and even the promotion of an asset class,
it severely limits its viability. The primary use case is effectively neutered for most users who rely on regulated access points. The money is just flowing toward compliance and structure, and it's leaving these non-compliant assets behind.
let's transition from that digital infrastructure to how AI and data tech are transforming physical infrastructure, specifically in the Middle East.
This ties right back to that data localization constraint we talked about. The need for high-level data security is driving massive IT investment. In the UAE, Abu Dhabi Airports and SATAM just signed an MOU to co-develop an AI-powered airport management system called ITM.
And this isn't just about better scheduling. ITM uses autonomous real-time decisions and shared data across all the airport partners
Airlines, air traffic control, ground handlers, everyone.
to boost on-time performance at Z International Airport.
The goal is predictive. Instead of just reacting to a delayed flight, the AI predicts the downstream effects of that delay and suggests fixes before the problem even escalates. It leads to a smoother journey for passengers and huge operational efficiency gains.
And in Saudi Arabia, AI is core to their Vision 2030 strategy, especially in customer experience.
They were facing a classic digital problem: uncoordinated communication. A single customer inquiry was triggering almost 100 repeated messages across different platforms.
It's just information overload, a terrible customer experience.
Awful. So their solution was to use Lemnisc, LMX, as a centralized decision layer. It unified the customer's intent across all those channels.
And the results were pretty staggering.
Oh, yeah. By connecting everything, the system cut the average number of interactions from 100 down to about 30. That efficiency translated to a 62-time return on investment.
Because customers got clearer, more relevant messaging.
And that improved conversion rates dramatically. And again, this deployment highlights the regulatory environment. Saudi Arabia has strict data localization rules. All customer data has to stay inside the country.
Which forces companies to use platforms like Lemnisc that can work fully inside Saudi clouds or private data centers.
Exactly. It completely shapes how their digital economy evolves.
This has been a dense, but I think a really instructive deep dive. We've seen this quiet, conservative legitimization of regulated digital assets.
Through Bank of America's guidance and Vanguard's huge platform reversal.
And we've also seen the infrastructure being built to handle it. Tokenization, regulated stablecoins.
While at the same time, niche non-compliant sectors like privacy coins are just hitting a massive regulatory wall. It shows that the smart money is flowing toward structure. It's flowing toward control.
And yet the core technologies behind all of this, AI and data analytics, are actively transforming major physical infrastructure and commerce globally.
It really is. It proves digital transformation is happening everywhere, whether you're talking about asset trading or airport performance.
The narrative isn't just about tech winning.
No. It's about compliance dictating where and how that technology is allowed to thrive.
And that leads us to our final provocative thought for you. Considering that huge traditional firms like Vanguard are opening the door to regulated crypto, and Bank of America is recommending a substantial 4% allocation, the crucial question for the industry isn't if the money will flow.
Because the Treasury inflows prove it already is?
But how quickly will competing banks be forced to match this new benchmark? Will they try to build these capabilities themselves, or will they be forced to go out and acquire the existing crypto custody and trading desks just to keep up and capture those new fees? Something to mull over as you watch the charts.